Bad news just became great news for Wall Street. The US posted its worst jobs report of the year, and stocks rallied to their best week since April. Here's everything that happened in the markets this week, in about 10 minutes. Let's start with the number that moved everything: July's jobs report. Economists expected the US to add 80,000 jobs. Instead, the economy lost 23,000. It's the second worst payroll print of the year, behind only February. And the damage goes deeper. The prior 2 months were revised down by a combined 103,000 jobs. Strangely, unemployment actually fell, from 4.2% to 4.1%, the lowest since June last year. Why? Fewer people were even looking for work. Labor force participation dropped to 61.4%. Wages told the real story. Average hourly earnings rose just 0.1%, a third of what was expected. Year-over-year wage growth came in at 3.2%, the weakest reading of the year. Construction added 22,000 jobs. Manufacturing added 5,000, its best month since March. But leisure, hospitality, retail, and government education all shed jobs. BlackRock's Rick Rieder called it a productivity revolution, companies doing more with fewer people. Markets read it as one thing: lower odds of a Fed rate hike in September. September hike odds collapsed from over 50% to under 40% overnight. The 2-year Treasury yield dropped to 4.17% on the news. That's exactly what markets wanted to hear. The S&P 500 closed the week up, near 7,745. The Nasdaq led gains, closing near 26,603. It was Wall Street's best week since April. And it's not just a rate cut story, earnings are genuinely strong this quarter. Gabelli Funds' John Belton called it one of the best earnings seasons he's seen in years. S&P 500 earnings growth is running in the high 20s%, well above expectations. Amazon said its AI spending is now paying back in under 3 years. Microsoft delivered a strong quarter and is visibly monetizing AI, not just building for it. Airbnb and Instacart both beat estimates and rallied hard on their results. But it wasn't all good news. Trade Desk crashed 17% on a massive guidance miss. This earnings season is rewarding real execution and punishing anyone who can't back up their valuation. Now the biggest story under the surface this week: AI is turning into a full-blown capital war. Google had a genuine earthquake. Jeff Dean, one of its most important engineers in 3 decades, is leaving to start his own company. Demis Hassabis is also stepping back as head of DeepMind, moving into a chairman and chief scientist role. Cohere's CEO called it a huge shock, but said talent leaving big labs is actually healthy for the wider AI industry. Inside Alphabet, Google Cloud and DeepMind are fighting over the same scarce resource: AI computing power. Google Cloud is leasing that scarce compute to outside customers, including Anthropic, a direct rival to its own Gemini model. The price tag is enormous. Alphabet has raised roughly $80 billion in debt since October. This week alone, $25 billion in new bonds, oversubscribed 4 times over. Alphabet's free cash flow just turned negative. The company has paused its share buybacks entirely. And Alphabet isn't alone. Free cash flow is evaporating across the biggest AI spenders. Meta's free cash flow collapsed to under $800 million this quarter. Amazon posted a negative $7.6 billion in free cash flow for the year. Even Microsoft's free cash flow, still positive, is down 23% year-over-year. All that AI debt is now competing directly with the US government for capital in the bond market. One warning from this week: a hedge fund betting on AI winners over AI losers, with heavy leverage, lost 80% in a single month. The lesson: correlated AI bets, especially leveraged ones, can blow up fast. Meanwhile, the AI race is going global. China's DeepSeek is raising $8 billion to build a full gigawatt data center. And venture money keeps flowing. Sequoia Capital just put $2.5 billion into Anthropic. If AI is becoming a physical story, one metal proves it: copper. Copper prices are up 50% this year alone. AI data centers need massive amounts of copper for wiring, cooling, and power systems. But supply can't keep up. It takes about 17 years to bring a new copper mine online. The US has only 2 operating smelters left. That mismatch between soaring demand and slow supply is creating a structural price floor. Let's close the loop on something running under the whole week: the yen. For the first time in about 15 years, the US joined Japan in a coordinated currency intervention. The yen had hit 40-year lows near 164 against the dollar. One Bloomberg analyst called the move a chewing gum fix, short-term relief, not a real solution. Why does the US even care? Japan holds over $1 trillion in US treasuries. Washington is worried Tokyo could sell them off to defend the yen, pushing US borrowing costs even higher. By Friday, the 10-year Treasury yield had eased slightly to 4.62%. But the 30-year mortgage rate still hit 6.69%, the highest in over a year. So here's the week in one frame. The labor market is weakening, possibly because of AI adoption itself. That weakness gave the Fed room to look dovish, and markets rallied hard on it. Meanwhile, the companies building AI are burning cash at a historic rate, funded by tens of billions in new debt. And underneath the software story, it's copper, steel, and power grids doing the real work. Good earnings. Weak jobs. A currency intervention that hasn't stuck. And an AI build-out big enough to move bond markets. That's the setup heading into next week. See you then.